Silver alert, vanishing instantly. This has never occurred before. January 2026. The world's largest bullion dealers went dark. SD Bullion, Bullion, APMEX, all reporting the same crisis simultaneously. 1,000-ounce bars, the backbone of institutional silver trading. Gone. Not delayed, not back-ordered. Gone. 5-week shipping delays. Google searches for buy silver just shattered every record in history, even surpassing the 2011 frenzy. But here's what they're not telling you. Central banks just crossed a threshold, a line they haven't crossed in 45 years. 2 veteran analysts, decades of experience between them, are now calling for $100 silver, not in 5 years, not in 2 years, within 60 days. And the geopolitical event that unfolded this past weekend could accelerate everything. What you're about to discover has never happened in modern market history. Welcome to Currency Analyzer, where we deliver the financial intelligence that truly matters. If you've witnessed enough market cycles to know that wisdom comes from experience, not algorithms. If you remember when financial advice was built on decades of observation, not fleeting trends, then you understand the value of analytical clarity in uncertain times. We'd be honored to have you join this community. That subscribe button below, think of it as pulling up a chair to a conversation worth having. The kind of discussion where experience is respected, where analysis matters more than entertainment. One click, and you'll never miss the strategic insights that could reshape how you view the markets ahead. Now, we're curious. Where in the world are you watching from today? Are you following this from somewhere in North America, where these silver shortages are being felt most acutely? Perhaps you're in Europe, where markets open before dawn and currency concerns run deep? Or maybe you're watching from Asia Pacific, where the next trading session is about to begin. Australia, the Middle East, South America? Drop your location in the comments below. We'd genuinely like to know whose company we're keeping in this analysis, because what's unfolding in the silver market right now affects every corner of the global economy, and the next 60 days will reveal whether this is a warning or the beginning of something far larger. Let's examine exactly what's happening. The signs appeared quietly at first, then all at once, they became impossible to ignore. In the first week of January 2026, something extraordinary began unfolding across the global silver market. Something that veteran traders with 40 years of experience had never witnessed before. The major bullion dealers, the giants of the precious metals industry, SD Bullion, Bullion, and APMEX, all reported the same alarming development simultaneously. The 1,000-ounce COMEX good delivery bars, the massive silver bars that formed the foundation of institutional trading, the bars that banks and large investors use to settle contracts worth millions, were completely sold out. These weren't small retail coins or collectible pieces. These were the serious bars, the ones that move in armored trucks, not shopping carts. When these bars disappear from inventory, it signals something far deeper than casual investor interest. It indicates that major players, institutional money, sophisticated wealth managers, were scrambling to secure physical metal in quantities that most people never even see. But the shortage wasn't limited to wholesale markets. A veteran coin dealer in St. Louis, someone who had worked behind the counter for over 20 years, was explaining to customers that inventory levels had reached concerning levels. This wasn't a man prone to exaggeration. This was someone who had seen the 2008 financial crisis, who had watched the 2011 silver spike, who had navigated the pandemic buying frenzy of 2020. And he was saying this felt different, more intense, more urgent, more sustained. The online dealers painted an even clearer picture. One by one, major websites began posting unusual notices. TD Precious Metals announced delivery delays of 10 to 25 business days. That's 5 full weeks for orders to ship. Other dealers followed with similar warnings. Due to high demand, shipping timelines may be extended. Certain products available for pre-order only. A limited inventory, first come, first served. These weren't marketing tactics to create artificial urgency. These were genuine capacity warnings from companies struggling to keep pace with demand. Then came the data that even skeptics couldn't dismiss. Google search analytics revealed something remarkable. Searches for the phrase buy silver had reached all-time highs. Higher than 2011, when silver briefly touched $50 per ounce. Higher than 1980, when the Hunt brothers attempted to corner the market. Higher than the pandemic surge in 2020. The graph showed a nearly vertical line climbing into unprecedented territory. Millions of people worldwide were simultaneously searching for the same thing: how to acquire physical silver. And they were doing it right now. But here's where the situation became truly interesting. Throughout history, retail demand for silver didn't actually set the price. The power belonged to the paper markets, the futures exchanges, the COMEX in New York, the London bullion market. These institutional venues determined what silver should cost based on contracts and derivatives, most of which never involved actual physical metal changing hands. Retail buyers simply paid whatever premium the market demanded above that paper price. If silver traded at $30 on the COMEX, a retail buyer might pay $35 for a physical coin. The $5 difference was the premium, the cost of converting paper promises into real metal. When retail demand surged, premiums would rise, maybe to $8 over spot, or $10, or even $15 during extreme shortages. But the underlying price, that remained controlled by the paper markets. Until now, something fundamental was shifting. The physical market was beginning to assert its own authority. The tail was starting to wag the dog. Experts in the industry began using a specific term to describe what they were witnessing. Not a shortage exactly, not yet a squeeze in the technical sense, but definitely a scramble. A scramble meant that physical metal was becoming genuinely difficult to source at current prices, that buyers were actively competing for available inventory, that the usual smooth flow of supply was experiencing serious friction. And when physical demand begins overwhelming paper supply mechanisms, when real buyers with real money demand real metal, the entire pricing structure of a commodity market can transform overnight. The question wasn't whether this scramble would intensify. The data made that answer obvious. The real question was what would happen when the scramble evolved into something more severe, when inventory didn't just run low, but ran out completely. And that question was about to be answered in ways that would shock even the most seasoned market observers, because what was happening in the silver market wasn't just a temporary supply disruption. It was the beginning of a structural transformation, one that would force a complete reassessment of silver's true value in the modern economy. But to understand why this transformation was inevitable, one had to look beyond the retail panic. One had to examine what the world's central banks were doing behind closed doors. And what they were doing hadn't happened in 45 years. While ordinary investors were fighting over silver coins at local dealers, a far more significant drama was unfolding in places most people would never see. In the boardrooms of central banks, in the strategy sessions of sovereign wealth funds, in the private vaults where nations store their reserves. A chart emerged in late 2025 that should have dominated every financial news channel. But somehow, it slipped past most mainstream media outlets. The chart was simple. 2 lines, tracked over 5 decades. One line represented foreign central bank holdings of gold. The other showed their holdings of United States Treasury bonds. For 45 years, from 1980 until very recently, the world's central banks held more American debt than physical gold. They trusted paper promises from the US government more than tangible metal. That made sense for decades. US Treasuries paid interest. They were liquid. They were considered the safest asset on earth. Gold just sat in vaults earning nothing. But then, in 2025, something changed and the lines crossed. For the first time since the early 1980s, central banks now held more gold than US Treasuries. Not by a small margin, by a significant, undeniable margin. The smartest financial minds on the planet, the people managing trillions in national reserves, the institutions that move markets with a single decision, were quietly, methodically, shifting away from paper and into metal. This wasn't speculation. This was documented fact. Country after country, from China to Russia, from India to Poland, from Singapore to Turkey, were accumulating physical gold at rates not seen in generations. And where gold goes, silver inevitably follows. But here's what makes silver different. Gold carries monetary history. The weight of thousands of years is a store of value. Silver carries that same history, but silver possesses something gold doesn't. Industrial necessity. Every solar panel manufactured today requires silver. Every smartphone contains it. Every electric vehicle needs it, in quantities that cannot be substituted. The artificial intelligence revolution consuming the technology sector, the massive data centers powering AI systems, they're built with silver-laden components that have no viable alternatives. Gold can sit idle in a vault for centuries. Silver gets consumed, destroyed, used up in ways that can never be recovered. When silver becomes part of an electronic circuit board, when it's embedded in a solar panel, when it's integrated into a vehicle's electrical system, it's gone from the investment pool forever. The metal doesn't disappear from Earth, but it disappears from economic circulation, scattered across billions of devices in quantities too small to ever be economically recovered. And yet, in early January 2026, silver was trading at just $75 per ounce, which is where 2 analysts entered the picture with projections so bold they would have been dismissed as absurd just 12 months earlier. The first analyst, a veteran with over 30 years tracking precious metals markets, released a report in early January. His projection was straightforward. Silver would reach $100 per ounce within 60 days. Not a possibility, not a maybe, a projection based on supply-demand fundamentals he had never witnessed in his entire career. The second analyst, equally experienced, equally respected, came to the same conclusion through a completely different methodology. He examined above-ground silver inventories. He calculated annual industrial consumption. He analyzed mining production rates and declining ore grades. His conclusion matched the first analyst's timeline almost exactly. 60 days, possibly less. These weren't promotional figures trying to sell newsletters. These were serious market analysts with reputations built over decades, suddenly willing to stake those reputations on an extreme near-term price target. What did they see that others were missing? They saw the mathematics of scarcity playing out in real time. Global silver mine production had plateaued. No major new discoveries were coming online. Existing mines were processing lower-grade ore, requiring more energy and resources to extract the same amount of metal. Meanwhile, industrial demand was accelerating. The transition to renewable energy wasn't slowing down. Electric vehicle production was expanding. The AI infrastructure build-out was consuming materials at unprecedented rates. And now, on top of that industrial consumption, investment demand was surging. On top of that industrial consumption, investment demand was surging. The scramble that began in retail markets was spreading. Institutional buyers were entering the physical market, not to trade, but to hold. Not for speculation, but for strategic positioning. They understood what the crossing of those two lines meant. When central banks choose gold over treasuries, they're making a statement about confidence in paper currency systems. When that statement is made, smart money follows. And the smartest money understands that silver offers everything gold provides, plus the industrial demand that makes it irreplaceable in the modern economy. But there was one more factor accelerating this transformation. A geopolitical development that occurred over the weekend before this analysis. An event that few people connected to the silver market, but those who understood global supply chains, those who tracked resource flows between nations, they saw the connection immediately, and they understood that what was already a scramble was about to become something far more intense. The mathematics were undeniable, but mathematics alone don't move markets this violently. Fear does, urgency does, and the recognition that a window of opportunity is closing that moves markets faster than any calculation. The two veteran analysts weren't simply looking at supply and demand charts when they issued their 60-day projection to $100 per ounce. They were looking at something far more revealing: the behavior of sophisticated institutions. Large financial entities don't panic. They don't chase prices. They don't scramble for assets unless they've identified a structural problem that cannot be easily resolved. And in late December 2025, their behavior changed. Quietly, without announcement, major investment firms began accumulating physical silver positions. Not through ETFs, not through futures contracts. Physical metal, delivered to secure facilities, removed from circulation. One analyst described what he was witnessing as the smartest people in the room all heading toward the same exit at once, but trying very hard not to run. The exit was paper assets. The destination was physical commodities. But why the urgency? Why now? The answer lay in a convergence of factors that had never aligned simultaneously in market history. First, the inventory situation. COMEX silver inventories, the registered stockpiles available for delivery against futures contracts, had dropped to levels that concerned even exchange officials. In 2020, COMEX held over 300 million ounces of registered silver. By January 2026, that number had fallen below 60 million ounces, a reduction of 80% in just 5 years. Meanwhile, open interest in silver futures contracts remained elevated. The paper claims on physical silver far exceeded the metal available to satisfy those claims. This created what market professionals call a delivery risk scenario. If even a modest percentage of contract holders demanded physical delivery instead of cash settlement, the exchange would face a crisis. Second, the mining reality. Silver mine production had peaked in 2015 at roughly 900 million ounces annually. By 2025, despite higher prices, production had declined to approximately 820 million ounces. The easy deposits had been exhausted. New discoveries were rare. Existing mines were processing lower-grade ore at higher costs, and the lead time to bring a new silver mine into production, assuming one was discovered, averaged 7 to 10 years. There was no quick supply response possible. Third, the consumption acceleration. The International Energy Agency projected that solar panel installations would triple between 2025 and 2030. Each gigawatt of solar capacity required approximately 75,000 ounces of silver. The electric vehicle sector was growing even faster. Each EV contained roughly 1 ounce of silver, triple the amount in traditional vehicles. Global EV production was approaching 20 million units annually, and accelerating. Then came the AI infrastructure explosion. Tech companies were spending hundreds of billions building data centers. Each facility required sophisticated electronics, power management systems, cooling infrastructure, all silver intensive, all non-substitutable. The metal was being permanently removed from circulation at rates that exceeded new mine supply. But the factor that transformed this situation from serious to critical was geopolitical. Over the weekend, a major silver-producing nation announced new export restrictions. Not an outright ban, but licensing requirements, quotas, strategic reserve obligations. The announcement was framed as ensuring domestic supply security for critical industries, but the effect was immediate. Global silver supply chains, already stretched thin, suddenly faced additional constraints. Other producing nations were watching. If one country could weaponize silver exports, others would follow. Resource nationalism was accelerating worldwide. Nations were beginning to view strategic commodities not as trade goods, but as geopolitical leverage. The implications were profound. For decades, the silver market operated on the assumption of relatively free global trade. That assumption was breaking down, and when countries restrict exports of critical materials, prices don't rise gradually, they spike violently. History provided clear examples. In 2010, China restricted rare earth exports. Prices increased by 400% in less than a year. In 2022, Russia's palladium supplies were disrupted by sanctions. Palladium prices doubled in weeks. In early 2022, nickel trading on the London Metal Exchange was suspended after prices increased by 250% in 2 days, breaking the exchange's systems. Silver was following the same pattern. Physical scarcity, combined with geopolitical supply risk, created the conditions for price dislocations that could overwhelm traditional market mechanisms. The analysts projecting $100 silver within 60 days weren't making wild guesses. They were calculating the mathematical outcome of a supply-demand imbalance under stress conditions. But even $100 per ounce might prove conservative, because embedded in these projections was an assumption. The assumption that markets would function normally, that exchanges would continue operating, that physical metal would remain available at some price. But what if those assumptions were wrong? What if the scramble evolved into something more severe? What if buyers with urgent needs, industrial manufacturers, defense contractors, technology companies, began competing directly with investment demand? What if sovereign nations decided silver was too strategic to allow free export? The analysts' 60-day projection to $100 assumed orderly market conditions. But nothing about the current situation appeared orderly. And the weekend's geopolitical developments suggested that order, predictability, normal market function were becoming luxuries the silver market could no longer afford. The question facing business leaders and capital allocators wasn't whether silver would reach $100. The question was what happens after $100, when the full implications of this structural shortage became impossible to ignore. The analysis was complete. The data was clear. The projections were documented. But analysis without application serves no purpose. For business leaders, for entrepreneurs, for those managing capital in an environment of accelerating uncertainty, the question wasn't what was happening to silver. The question was what to do about it. And that question demanded a framework, not emotion, not speculation, but strategic thinking grounded in historical precedent and practical reality. The first consideration was exposure. Not every business needed to respond to silver market dynamics, but more businesses than most realized had direct or indirect exposure to silver price movements. Electronics manufacturers, obviously exposed. Solar companies, directly impacted. Automotive suppliers serving the EV sector, significantly affected. But the exposure extended further. Any company with supply chains dependent on electronics, which meant virtually every modern business, faced potential disruptions. Rising silver costs would flow through to component prices, to finished goods, to profit margins. Companies that recognized this early, that secured supply contracts or hedged their exposure, would maintain competitive advantage. Those that waited would face difficult choices between absorbing costs or passing them to customers. But beyond operational exposure, there was the strategic question of capital allocation. Should businesses or individuals hold physical silver as part of their asset base? The question wasn't simple. Physical silver carried costs, storage, insurance, liquidity considerations. Unlike financial assets, it generated no cash flow, paid no dividends, provided no interest. Its value lay entirely in purchasing power preservation and potential appreciation. But that potential had to be weighed against historical patterns. Silver had reached $50 per ounce twice in modern history. In 1980, it crashed back to single digits within months. In 2011, it fell by 70% over the following years. Both times, those who bought at peaks suffered devastating losses. Both times, those who bought early and sold strategically made extraordinary returns. The lesson wasn't that silver was good or bad. The lesson was that timing and discipline mattered enormously. The current situation presented a different dynamic than 1980 or 2011. In 1980, the Hunt brothers' attempted corner created artificial scarcity that collapsed when leverage failed. In 2011, investor speculation drove prices without corresponding physical shortage. In 2026, the shortage was real, industrial consumption was real, central bank behavior was real, geopolitical supply constraints were real. This wasn't leverage-driven speculation. This was structural supply-demand imbalance intersecting with monetary system stress. But that didn't guarantee linear price increases or permanent gains. Markets overshoot in both directions. Silver could reach $100 or $150 or $200, and then it could fall back to $75 if conditions normalized. Or it could stabilize at elevated levels if structural changes proved permanent. The strategic approach required acknowledging uncertainty while acting on probability. For businesses with silver exposure, hedging made sense, securing supply contracts, forward purchasing critical components, exploring alternative technologies where possible. These weren't speculative actions. These were risk management fundamentals. For capital allocators considering silver as an asset, the framework was different. First, allocation sizing. No serious analyst recommended putting entire portfolios into any single commodity. Silver was volatile, illiquid compared to stocks or bonds, and carried storage costs. Historically, precious metals allocations in diversified portfolios ranged from 5 to 15%. The current environment might justify the higher end of that range, but discipline required boundaries. Second, form of ownership. Physical metal, ETFs, mining stocks, futures contracts, each carried different characteristics. Physical metal provided no counterparty risk, but required secure storage. ETFs offered liquidity, but introduced institutional intermediaries. Mining stocks provided leverage to silver prices, but added company-specific risks. Futures contracts offered price exposure, but required active management and carried rollover costs. The choice depended on objectives, timeline, and risk tolerance. Third, entry strategy. Attempting to time the exact bottom was futile. But dollar cost averaging, systematic accumulation over time, reduced the risk of buying entirely at peaks. If the thesis was correct, if silver was entering a multi-year structural shortage, then precise entry timing mattered less than establishing position before the broader market recognized the situation. Fourth, exit discipline. This was where most commodity investors failed historically. They bought with conviction, watched prices rise, became emotionally attached to positions, and held through subsequent crashes. Silver at $100 might be a beginning, or it might be a top. Establishing exit criteria in advance, price targets, time horizons, or fundamental conditions that would invalidate the thesis prevented emotional decision-making during volatility. But beyond individual portfolio decisions, there was a broader strategic reality that business leaders needed to recognize. The silver situation was a symptom of something larger. It reflected growing tension between paper financial systems and physical resource constraints. It demonstrated that decades of financialization, of derivatives, of paper claims exceeding physical assets, were creating structural vulnerabilities. It showed that geopolitical fragmentation was disrupting supply chains that globalization had taken for granted. Silver was one commodity. But the dynamics playing out in silver markets, physical scarcity, geopolitical supply risk, paper-physical disconnect, were emerging across multiple critical resources: copper, lithium, cobalt, rare earths, even energy markets. The businesses that would thrive in the coming years weren't those with the best financial engineering. They were those that secured physical supply chains, that understood resource constraints, that positioned strategically rather than reacting tactically. The entrepreneurs who would build enduring value weren't chasing digital trends. They were solving real-world problems, building tangible capabilities, creating businesses grounded in physical reality rather than financial abstraction. The silver alert wasn't just about one metal. It was about recognizing a fundamental shift in how the global economy was evolving, from abundance to scarcity, from globalization to regionalization, from paper promises to physical settlement. Those who recognized this shift early, who positioned strategically rather than waiting for certainty, would navigate the transition successfully. Those who waited for perfect information, who demanded proof before acting, would find that by the time the evidence was undeniable, the opportunity had passed. The 60 days had begun. The mathematics were clear. The question was no longer what would happen. The question was who would be positioned to benefit, and who would be caught unprepared when the invisible became obvious.